There are two programs in the United States that pay monthly cash benefits to disabled people. Two. That is it. Not 10, not 22. Two. And here is the thing. Most people who desperately need one of them cannot tell you the difference between them. Some apply for the wrong one and wait months for a denial letter. Some qualify for both at the same time and are leaving money on the table every single month. And some people are so overwhelmed by the alphabet soup, SSDI, SSI, SGA, FBR, that they give up before they even fill out a form. Today we are fixing that. We are going to take SSDI and SSI completely apart. What each program actually is, where the money comes from, who qualifies, how the benefits are calculated, what health insurance you get with each one, and most importantly, how to figure out which one applies to your actual situation. No jargon without explanation, no glossing over the complicated parts, and no pretending the system is simpler than it is, because it genuinely is not. But it is understandable. That is what we are here for. I am Drew. This is disability.co. Let us get into it. Before we get into eligibility rules and dollar amounts, I want to spend a few minutes on the philosophy behind these two programs. Because once you understand why each one was built the way it was, the rules stop feeling arbitrary and start making a certain kind of sense, even when they are frustrating. Both SSDI and SSI are administered by the Social Security Administration, the SSA. Same agency, same offices, sometimes the same staff you would talk to, which is a big part of why people conflate them. They look the same from the outside, but they are built on completely different foundations. Let me walk you through those foundations. SSDI, Social Security Disability Insurance. I want you to really sit with the word insurance, because it is doing a lot of work. SSDI is insurance. It functions like a policy you have been paying premiums into your entire working life. Every paycheck you have ever received, a percentage went to FICA taxes, Federal Insurance Contributions Act. Part of that money funds SSDI. So when you become disabled and can no longer work, you are not asking for a handout. You are filing a claim against an insurance policy that you paid for. And that is a reframe a lot of people need to hear. There is so much stigma around receiving government benefits, and the insurance framing cuts right through that. If your house burned down and you filed a homeowner's insurance claim, nobody would tell you that you are being a burden. SSDI is the same principle. You contributed. You are collecting. That is what insurance is. Now, SSI is a fundamentally different animal. SSI, Supplemental Security Income, is a needs-based program. It has nothing to do with what you paid in or how long you worked. It exists to provide a basic income floor to people with disabilities who have very limited financial resources. Full stop. It is funded not by Social Security payroll taxes, but by general federal tax revenue, the same pool that funds roads and schools. The program says, if you have a disability and you are essentially without resources, we will make sure you have something. So the two programs are really asking two completely different questions. SSDI asks, did you earn this? SSI asks, do you need this? Understanding that distinction explains almost everything else we are going to talk about today. It explains why SSDI benefits vary from person to person, and SSI is a fixed amount. It explains why SSDI has no asset limit, and SSI has a brutal one. It explains why the health insurance attached to each one is different. It all flows from that core philosophical split. One more thing before we get into the details. Some people qualify for both programs at the same time. It is called concurrent benefits, and it happens when your SSDI payment is low enough that you also meet the financial eligibility requirements for SSI. In that situation, you can receive both. SSI essentially tops you up. We will walk through the mechanics of exactly how that works in Chapter 5. I just want you to know it exists, because it is one of the most underutilized situations in the entire disability benefit system. So that is the foundation. SSDI and SSI. Two different philosophies, same agency. Let us go deep on each one. SSDI, Social Security Disability Insurance. Because it is an insurance program, the first question is always, are you covered? And coverage is determined by work credits. Let me explain work credits like you have never heard of them. Work credits are the SSA's way of counting your work history in a standardized way. Every year you work and pay Social Security taxes, you earn up to 4 credits. In 2024, you earn 1 credit for every $1,730 in earnings, and you max out at 4 credits for the year after earning $6,920. So if you made more than $6,920 in 2024, you earned your 4 credits for the year. It does not matter if you made $7,000 or $700,000. The credit system does not reward higher earnings. It just counts whether you worked. Credits accumulate over your lifetime, and they stay with you. You can look up your entire credit history right now at ssa.gov. You can look up your entire credit history right now at ssa.gov/myaccount. It is a free account. You log in and you will see your complete earnings record and exactly how many credits you have earned to date. I genuinely recommend everyone do this, not just people with disabilities. It is your record, and errors in it can affect your benefits. So how many credits do you need to qualify for SSDI? This is where people sometimes get tripped up because the answer is not a flat number. It depends on how old you were when you became disabled. The general rule for most adults is 40 credits, which is essentially 10 years of work, and 20 of those credits need to be from the most recent 10 years. The SSA calls this the recently worked test. The idea is that SSDI is meant to protect workers who are currently in the workforce, not someone who worked for a few years decades ago and has been out ever since. But younger workers get a significant break on this, because the SSA recognizes you cannot accumulate 40 credits if you have only been working for a few years. The sliding scale looks roughly like this. If you became disabled before age 24, you may only need 6 credits earned in the 3 years before your disability. Between 24 and 31, you need credits for half the time between 21 and the age you became disabled. From 31 onward, the formula moves toward the standard 40 credits. The SSA's website has a chart, and that link is in the description. But the point is, do not assume you do not qualify just because you are young. Run the actual numbers. Now, who tends to fall through the cracks on work credits? A few groups. People who did a lot of gig work, especially before platforms got serious about issuing 1099s, where income was not properly reported to the IRS and therefore did not generate Social Security credits. People who worked primarily in cash pay jobs, people who took long caregiving breaks from the workforce, and people who worked primarily part-time for years without ever hitting the annual credit threshold. That last one is trickier than it sounds. Working part-time at a low enough wage that you only earn 1 or 2 credits a year instead of 4 means a 15-year work history might only generate 25 credits. Okay, let us say you have the credits, your disability qualifies, you get approved. How is the actual benefit amount calculated? This is where SSDI really shows its insurance DNA. Your benefit is not a flat amount, it is calculated based on your actual lifetime earnings history. The SSA takes your entire earnings record, adjusts each year's earnings for inflation. That is the index part. Takes your highest 35 years, averages them into what they call the average indexed monthly earnings, or AIME, and then runs that through a formula to calculate your primary insurance amount, the PIA. Your monthly SSDI payment is essentially your PIA. Higher lifetime earners do get more, but not proportionally. The formula is designed to replace a higher percentage of income for lower earners. It is slightly redistributive. Someone who earned $30,000 a year on average will replace a larger fraction of their pre-disability income than someone who earned $120,000. The formula protects lower wage workers more. In dollar terms, the average SSDI benefit in 2024 is around $1,537 a month. The maximum is around $3,822, but that is only for people with consistently high lifetime earnings. Most people fall somewhere in the $800 to $2,000 range depending on their work history. And here is something important that a lot of people do not know. If you have dependents, a spouse, or children under 18, they may also be eligible for auxiliary SSDI benefits based on your earnings record. Each eligible dependent can receive up to 50% of your benefit, subject to a family maximum. The family benefits piece is massively underutilized. A parent with 2 young kids getting approved for SSD, I should immediately be asking about auxiliary benefits for those kids. It can significantly increase the total household income. Now let me talk about the waiting period, because you need to know about this before you are surprised by it. The 5-month waiting period is one of the most consistently brutal parts of SSDI, and it is important to understand exactly how it works. When the SSA determines that you have a disability, they establish what is called an onset date, the date your disability began. Your SSDI cash benefits do not start on that date. They start on the first day of the 6th full month after your onset date. So if your disability onset was January 15th, your first month of benefits would be July. You have received nothing for those 5 months. And given that the application process itself can take 6 months to a year or more, someone could realistically be 18 months from their onset date before they see a single check. That is not an exaggeration. It is genuinely common, which is why the interaction between SSDI and SSI as a bridge program during that waiting period is so important. If you are applying for SSDI and you have no income and very limited assets, applying for SSI at the same time can put money in your pocket while you wait. And then there is the Medicare waiting period on top of that. And this catches people completely off guard. The Medicare waiting period is one of the most significant practical challenges in the SSDI system, and it gets almost no attention. When you are approved for SSDI, you do not get Medicare immediately. Medicare eligibility begins 24 months after your first month of entitlement, meaning after your first SSDI payment month. So in practice, if you got approved, waited through the 5-month waiting period, and your first check arrived in month 6, your Medicare does not kick in until month 30. Almost 2.5 years after your disability began, you may still not have health insurance through the program. Fair use. Visual reference while discussing policy gap, which is obviously a crisis for anyone with significant ongoing medical needs. So what do people actually do during that gap? A few options. If you had employer-sponsored insurance, COBRA lets you continue it for up to 18 months, though COBRA premiums can be very expensive without employer contribution. Marketplace plans through healthcare.gov are available, and SSDI recipients may qualify for subsidies. And again, if you financially qualify for SSI concurrently, you get Medicaid through that pathway, which solves the healthcare gap immediately. 2 exceptions worth knowing. ALS, Lou Gehrig's disease, gets Medicare from the very first month of SSDI entitlement. No waiting period. And end-stage renal disease has its own separate Medicare rules. So if you have ALS, that 24-month wait is entirely waived. It is one of the few places where the SSA explicitly recognized that a 2-year wait was unconscionable for a specific population. Now let us talk about working while on SSDI. This is the thing people are most afraid of and most confused about, and the fear is understandable but often disproportionate to reality. The SSA uses a concept called Substantial Gainful Activity, SGA, as a threshold. In 2024, SGA is $1,550 a month in gross earnings for non-blind individuals and $2,590 for blind individuals. If you are earning above SGA, the SSA generally considers you capable of substantial work. Below SGA, you can work and keep your benefits, which is obviously a crisis for anyone with significant ongoing medical needs. So what do people actually do during that gap? A few options. If you had employer-sponsored insurance, COBRA lets you continue it for up to 18 months, though COBRA premiums can be very expensive without employer contribution. Marketplace plans through healthcare.gov are available, and SSDI recipients may qualify for subsidies. And again, if you financially qualify for SSI concurrently, you get Medicaid through that pathway, which solves the healthcare gap immediately. 2 exceptions worth knowing. ALS, Lou Gehrig's disease, gets Medicare from the very first month of SSDI entitlement. No waiting period. And end-stage renal disease has its own separate Medicare rules. So if you have ALS, that 24-month wait is entirely waived. It is one of the few places where the SSA explicitly recognized that a 2-year wait was unconscionable for a specific population. Now let us talk about working while on SSDI. This is the thing people are most afraid of and most confused about, and the fear is understandable but often disproportionate to reality. The SSA uses a concept called substantial gainful activity, SGA, as a threshold. In 2024, SGA is $1,550 a month in gross earnings for non-blind individuals and $2,590 for blind individuals. Now, let us turn to SSI. And I want to start this chapter by saying out loud, SSI covers people who the SSDI system completely fails. And that is a design feature, not a flaw. They are covering different populations. SSI was created explicitly to catch the people who fall outside SSDI's coverage. 3 primary groups. First, people with disabilities who never accumulated enough work credits, either because they became disabled before they could work, or because their work history was too limited or too informal to generate credits. Second, children with disabilities. Yes, minors under 18 can receive SSI. Third, adults 65 and older with limited income and resources, regardless of disability. That third group often surprises people. You do not have to have a disability to potentially receive SSI if you are over 65 and have very limited means. And this is funded completely differently than SSDI. Now, let us turn to SSI. And I want to start this chapter by saying out loud, SSI covers people who the SSDI system completely fails. And that is a design feature, not a flaw. They are covering different populations. SSI was created explicitly to catch the people who fall outside SSDI's coverage. 3 primary groups. First, people with disabilities who never accumulated enough work credits, either because they became disabled before they could work, or because their work history was too limited or too informal to generate credits. Second, children with disabilities. Yes, minors under 18 can receive SSI. Third, adults 65 and older with limited income and resources, regardless of disability. That third group often surprises people. You do not have to have a disability to potentially receive SSI if you are over 65 and have very limited means. And this is funded completely differently than SSDI. SSDI is funded by the Social Security Trust Fund, fed by FICA payroll taxes. SSI is funded by the General Fund, the same pool of federal tax revenue that pays for everything else the federal government does. That distinction matters because it is why SSI comes with much tighter eligibility conditions. Congress is deciding how much of general tax revenue to allocate to this population, and the restrictions on income and assets reflect that political calculus. Now let us talk about the asset limit, because when I first learned this number, I genuinely thought I had misread it. $2,000. To qualify for SSI as an individual, your countable assets cannot exceed $2,000, $3,000 for a married couple. $2,000. That is less than a month's rent in most American cities, and it has not changed since 1989, 35 years. The federal government set this limit during the Reagan administration and has never once adjusted it for inflation. If you ran that $2,000 through a CPI calculator, it would need to be somewhere around $4,800 today just to have the same purchasing power it had when it was set. In real terms, the asset limit has been cut roughly in half. There have been efforts to change it. Bills have been introduced in Congress multiple times to raise the asset limit, often to $10,000 or higher. They have not passed. The SSI Savings Penalty Elimination Act is one that gets reintroduced fairly regularly. Disability advocates have been pushing on this for years. But as of today, it is still $2,000 for an individual. And this creates what people call the poverty trap. The trap is real, and it is maddening. If you are on SSI and you work a few extra hours and manage to save up $2,001, you have technically disqualified yourself from SSI until you spend back down below the limit. The system creates a perverse incentive to not save, which is exactly backwards from what healthy financial behavior looks like. You cannot build an emergency fund. You cannot save for a car. You cannot set aside money for a medical expense you know is coming. The asset limit punishes the kind of financial prudence that every financial advisor in the country tells people to practice. And this is where ABLE accounts become critically important. ABLE accounts are one of the best tools in the disability financial planning toolkit, and they are significantly underutilized. An ABLE account, established under the Achieving a Better Life Experience Act passed in 2014, is a tax-advantaged savings account specifically for people with disabilities that began before age 26. Money in an ABLE account does not count toward the SSI asset limit. You can contribute up to $18,000 a year into an ABLE account, and if you are employed, you can contribute even more up to the federal poverty level amount. The money can be used for a wide range of disability-related expenses: housing, transportation, education, health and wellness, technology. For SSI recipients who want to save any money at all without losing benefits, an ABLE account is often the mechanism that makes that possible. What else is excluded from the asset limit aside from ABLE accounts? A few important exclusions. Your primary home, the place you live, does not count as a resource regardless of its value. One vehicle, regardless of what it is worth, as long as it is used for transportation by the recipient or their household. Life insurance policies with a face value of $1,500 or less. Certain burial funds and burial spaces. Items needed for self-support, meaning tools or equipment you use to earn income. An ABLE account balances up to $100,000. So the $2,000 limit applies to bank accounts, stocks, a second car, a savings bond, anything like that. But those specific exclusions can be significant. Now, the income rules. These are genuinely complicated, and if you are doing detailed SSI planning, you really want a benefits counselor helping you with the math. But here is the framework. The SSA distinguishes between earned income, meaning money from work, and unearned income, meaning everything else. Social Security benefits, pension payments, interest income, gifts. For unearned income, the SSA disregards the first $20 a month and counts the rest. For earned income, they disregard the first $65 a month plus half of everything above that. So your SSI payment gets reduced as income increases, but it does not disappear at the first dollar of income. Let me give you a concrete example. Say someone on SSI works part-time and earns $500 a month. The SSA first subtracts $65, the earned income exclusion, leaving $435. Then they subtract half of that, $217.50. So $217.50 of countable earned income reduces the SSI payment by $217.50. If the maximum federal SSI payment is $943, this person would receive $943 minus $217.50, which is $725.50 in SSI, plus their $500 in earnings. Total income, $1,225.50. That is meaningfully more than $943 alone. And that is an important point. Working does not just reduce your SSI dollar for dollar. For every $2 you earn above the exclusions, SSI goes down by $1. So there is always a net benefit to working. The system, at least in this regard, was designed to incentivize work, not punish it. The actual benefit amount for SSI, the federal benefit rate, the FBR, is the maximum SSI payment set by Congress annually. In 2024, it is $943 a month for an individual, $1,415 for an eligible couple. This is the ceiling if you have no other countable income. Many states add a state supplement on top of the federal rate. California and New York, for example, have significant state supplements that push the monthly total meaningfully higher. But the federal floor is $943. That is, for the record, below the federal poverty line. SSI alone is not designed to lift you out of poverty. It is designed to ensure you have something. Now, the Medicaid piece. And this is where SSI potentially has a significant practical advantage over SSDI for people with high medical needs. When you are approved for SSI in most states, Medicaid kicks in essentially automatically. Not after a 24-month wait like SSDI's Medicare. Right away. And that distinction is enormous for someone who has significant ongoing healthcare needs. Medicaid typically covers things Medicare does not: dental, vision in many states, long-term services and supports, personal care attendance. And for low-income recipients, the out-of-pocket costs through Medicaid are generally much lower than Medicare's cost-sharing structure. If your situation involves both limited income and high medical costs, the immediate Medicaid access through SSI is a major practical consideration. One more critical topic: SSI for children. Parents of disabled children need to know this. For a child under 18 to receive SSI, two things need to be true. First, the child must have a medically determinable physical or mental impairment that results in marked and severe functional limitations and is expected to last at least 12 months or result in death. Second, the family must meet income and asset requirements. The SSA uses a process called deeming. They take a portion of the parent's income and assets and attribute it to the child's eligibility. So even though the child has no income of their own, a family with significant income might not qualify because of deeming. And here is what happens at 18. At 18, the child is re-evaluated under adult SSI criteria. Deeming stops. The parent's income no longer counts. The young adult is evaluated solely on their own income, assets, and the adult disability standard. For many young adults with disabilities, this transition at 18 is actually the moment they first become eligible for SSI, or become eligible for a higher benefit, because the parental income that was being deemed away is no longer a factor. That transition point is critical to plan for. SSDI requires a qualifying work history. You need those credits. You need to have paid in. If you have never worked or worked very little, SSDI almost certainly is not available to you regardless of how severe your disability is. SSI has no work history requirement. The question is purely whether your disability is severe enough and your income and assets are below the limits. These are genuinely different gates. Difference 2. Benefit amount. SSDI is individualized. Your specific lifetime earnings determine your payment, and the average is around $1,537 a month, with a ceiling of about $3,822. SSI is standardized. The federal benefit rate of $943 for everyone, reduced by countable income. For someone with a substantial work history, SSDI will almost always pay more. For someone who worked minimally or not at all, SSI is the option and the benefit is fixed. Difference 3, and I think this might be the most practically impactful one for a lot of people. Healthcare. SSDI comes with Medicare, but you wait 24 months from your first entitlement month. During that window, you have no Medicare, and you need to find coverage elsewhere. SSI comes with Medicaid in most states, and the enrollment happens much faster, sometimes the same month as SSI approval. For someone managing a condition that requires regular medical care, expensive medications, or specialist visits, that Medicaid through SSI can be life-saving during a period when Medicare has not kicked in yet. This is one of the concrete reasons concurrent benefits is worth pursuing if you qualify for it. Difference 4. Asset limits. And these could not be more different. SSDI has no asset limit. 0. You can have $1 million in a savings account and still receive SSDI as long as your work credits and disability qualify. SSI caps you at $2,000 in countable assets. This is a massive real-world difference. SSDI recipients can save, invest, own multiple properties, and their benefits are unaffected. SSI recipients are essentially prohibited from accumulating savings without the ABLE account workaround. And that is one of the clearest illustrations of the philosophical difference between the two programs. SSDI is an earned benefit. What you own does not matter. SSI is a needs-based benefit. What you own determines whether you are needy enough. Difference 5. Population covered. SSDI specifically serves workers, people who paid into the system. SSI serves disabled adults who lack a qualifying work history, disabled children, and low-income elderly adults. If you became disabled at birth or as a young child, or have spent most of your adult life as a caregiver rather than a waged worker, SSI is the program that was built for you. The populations are genuinely different. And I want to add a sixth one, the denial rate and what it actually means. The SSA denies approximately 60 to 70% of initial SSDI applications. That statistic needs to be heard and understood by anyone going through the process. More than half of initial applicants are denied. But denial at the initial level is often not the end of the road. The appeals process is multi-stage: reconsideration, then a hearing before an administrative law judge, then further appeals if needed. The approval rate at the ALJ hearing stage is significantly higher than at the initial application stage. Many people who are ultimately approved were first denied. If you get denied, you are not alone, and it may not mean you do not qualify. It may mean your application needs strengthening, or that you need legal help. Now we ask whether your income and assets also qualify you for SSI, because you might qualify for both. This is the concurrent benefits question. If your projected SSDI benefit is low, say under $943, and your total countable income, including that SSD, I would still be below the SSI limits, and your assets are under $2,000, you may be eligible for SSI as well. Apply for both simultaneously. Let the SSA sort out the interaction. Do not self-select out of SSI because you think you are an SSDI person. Many people are both. Let me walk through the concurrent scenario concretely. Say your SSDI benefit based on your earnings history works out to $600 a month. The SSI federal benefit rate is $943. The SSA treats your SSDI as countable unearned income against your SSI eligibility. They subtract the $20 general exclusion, and the remaining $580 counts against SSI. So your SSI payment would be $943 minus $580, which is $363. Your total monthly income, $600 plus $363 equals $963. That is $20 more than SSI alone. Plus, critically, you are receiving SSI, which likely means you qualify for Medicaid. So you have solved both the income gap and the 24-month Medicare wait in a single move. That is a genuinely meaningful difference, and it is why you need to apply for both if there is any chance you qualify. If you are deep in this territory, trying to model out your exact benefit amounts, figure out your deeming situation, understand how your specific state's Medicaid rules interact with your SSI, this is where a benefits counselor is genuinely invaluable. The SSA funds a program called Work Incentives Planning and Assistance, WIPA. These are trained counselors available at no charge who specialize in exactly this kind of analysis. The number is 1-866-968-7842. Centers for Independent Living in your area may also have benefits counselors on staff. This is not the kind of modeling you want to do alone from a forum post. Get actual help. And if you think you have been improperly denied, file for reconsideration. File it within 60 days of your denial notice. Do not let the deadline pass. After reconsideration, if you are still denied, request a hearing before an administrative law judge. And I would strongly recommend having a disability attorney by that stage. Most disability attorneys work on contingency. They only get paid if you win, and their fee is capped by law at 25% of your back pay up to about $7,200. There is no upfront cost. If your case has merit, an attorney will typically take it. All right, SSDI and SSI, let us make it actionable. Here are the 3 things you should actually do after this episode. Step 1. Go to ssa.gov/myaccount and create a My Social Security account if you do not already have one. Look at your earnings record. Make sure the numbers are right, because errors do happen. Check how many work credits you have. That is the foundation of understanding whether SSDI is in your picture. Step 2. If you think there is any possibility you qualify for SSI, even if you are primarily applying for SSDI, apply for both. File concurrent applications. Let the SSA do the math on how the benefits interact. You cannot be penalized for applying for something you do not qualify for. The worst outcome is a denial. The best outcome is you get both. Apply for both. Step 3. Before you file anything, talk to a benefits counselor or disability attorney for at least a consultation. The application itself, what evidence you submit, how you describe your limitations, which onset date you establish, has a major impact on whether you get approved and how much you receive. If this was useful, share it with someone who needs it. The people who most need this information are often the least likely to find it. That is what we are here to change. I am Drew. This is disability.co. We will see you next time.